By mid-March 2026, market sentiment indices are flashing extreme fear. Yet, defying that panic, the broader crypto market cap is holding resilient at $2.35 trillion. But the asset class is no longer moving together. It is actively splitting into entirely different macroeconomic tracks. To understand why the sentiment is so bleak, you have to look outside digital assets. Escalating conflicts in the Middle East have placed severe physical constraints on global energy supply. Those geopolitical pressures have forced crude oil prices to surge over $100 per barrel, directly reviving fears of stubborn global inflation and tightening corporate margins. Meanwhile, traditional tech equities are absorbing the brunt of this energy shock. Historically, digital assets would crash right alongside the Nasdaq during such risk-off events. But today, that historical correlation is actively breaking down. For investors, this creates a profound dilemma. The reliable 4-year playbook where Bitcoin leads the charge and every alternative coin immediately follows in its wake is officially dead. Instead, we are witnessing severe market fragmentation. Individual crypto assets are behaving wildly differently from one another, driven by a stark divide. Some are propped up by deep institutional backing, while others rely strictly on their technical on-chain utility. By analyzing the specific mechanics behind Bitcoin, Ethereum, Solana, and Cardano, we can see where capital is actually flowing and how that movement contrasts with blind momentum. If you continue to treat the 2026 crypto ecosystem as a single unified monolith, you will inevitably bleed capital. Survival right now requires recognizing how the market has internally decoupled. We begin with Bitcoin. On March 13th, the asset successfully broke through heavy resistance to reach roughly $72,300. In doing so, Bitcoin proved it is decoupling from the Nasdaq. Rather than behaving like a speculative tech stock, it is trading as a distinct macroeconomic safe haven. The structural driver preventing Bitcoin from falling is relentless institutional integration. U.S. spot Bitcoin ETFs are absorbing $50 million to $70 million in daily net inflows, allowing Wall Street to inject capital without handling the actual cryptocurrency. But this massive capital floor comes with a strict trade-off. Institutional gravity means Bitcoin is currently trapped in what market analysts categorize as a transition phase. This chart shows Bitcoin's price tracking from its all-time high of approximately $126,000 in October 2025 down to its current level of $72,300. This highlights a persistent, massive 43% gap from its peak. That 43% deficit indicates that the days of explosive, asymmetrical tenfold returns are likely behind us for this specific asset. The sheer amount of capital required to move a trillion-dollar asset severely caps its upward velocity. This makes Bitcoin the ideal allocation for the capital preserver. This is an investor highly sensitive to Middle East tensions and rising oil, who needs a safe harbor completely detached from the equities market. Allocating to Bitcoin today is a purely defensive play. You secure ironclad downside protection through daily ETF inflows, but you must accept a significantly lower relative upside compared to earlier market cycles. Away from the institutional floor of Bitcoin, the smart contract platforms are showing a massive internal contradiction between how they are being used and how they are being priced. Ethereum perfectly illustrates this. The network's foundational metrics, like active user addresses and smart contract interactions, are currently hitting all-time highs. Smart contracts are self-executing code stored on the blockchain that automatically trigger when specific conditions are met. This chart shows Ethereum's price stagnating around $2,125, while a secondary line representing network usage sharply diverges and spikes upward. Despite peak utility, the broader market is ignoring these fundamentals. Capital allocators are waiting for a specific 2026 catalyst to prove the network can handle the load efficiently. That highly anticipated catalyst is the Glamsterdam upgrade. A major network patch, version 1.17.1, was deployed around March 12th, directly targeting system performance and security constraints. To confirm that the market actually values this upgrade, analysts need Ethereum to decisively break the $2,200 resistance line. Clearing that specific ceiling signals a path back toward the $4,000 range later this year. We see a strikingly similar technical stagnation playing out right now on Solana. After dropping from its 2025 peaks, Solana has entered a low volatility accumulation phase, firmly stabilizing between $80 and $94. The investor sentiment here remains cautiously constructive. The network is absorbing massive developer activity as the ecosystem braces for upgrades designed to radically boost transaction throughput. There are two dual technical catalysts dictating Solana's timeline: the upcoming Alpenglow upgrade and the full launch of FireDancer. FireDancer is a new validator client, which is the specialized software that allows independent computers to verify and secure transactions on the network. Technically, a decisive close above that $94 boundary removes the primary structural hurdle, creating a path toward $115. Choosing this fundamentals path by buying Ethereum or Solana means you must comfortably weather short-term price stagnation. You are trusting that the impending 2026 technical upgrades will force the wider market to eventually reprice the assets based on their actual utility. Finally, there is Cardano. This is the ultimate testing ground for the highly risk-tolerant contrarian investor, as the asset has endured a remarkably brutal start to 2026. This chart shows Cardano's severe 22% year-to-date drop, highlighting how it is currently clinging to a critically fragile neckline support level at just 24 cents. But the underlying data reveals a massive contradiction. In early March, as retail investors panicked over the price, Cardano's DeFi Total Value Locked, or TVL, actually spiked by 23%. TVL is an on-chain metric that measures the total dollar value of all cryptocurrency actively deposited within a network's financial applications. Adding to this anomaly, major network whales, entities holding massive quantities of the token, quietly accumulated $35 million worth of ADA over that exact 7-day window. These large holders are accumulating ahead of Protocol version 11, the Van Rossum hard fork. A hard fork is a major network upgrade requiring all nodes to adopt new software rules. The whales are betting that the upcoming Plutus performance improvements in this fork will eventually reverse the negative price trend. This brings us back to the reality of mid-March 2026. With the market fractured into distinct behavioral camps, your first step is actively defining your own investor profile. This chart displays a direct decision matrix for allocating your capital. The Capital Preserver profile routes to Bitcoin to lock in ETF-backed safety, explicitly trading away high peak returns for lower volatility. The Fundamentals Optimizer profile accepts moderate risk, routing to Ethereum or Solana. This investor ignores current stagnation to capture the delayed upside of the Glamsterdam and FireDancer upgrades. And the high-risk contrarian profile routes straight to Cardano, buying at deep discounts alongside whales, while accepting the massive risk that the broader market may never acknowledge the rising network activity. In a completely decoupled crypto market, blindly guessing at uniform price momentum is a direct and dangerous trap. Your internal risk calibration, mapped against specific asset catalysts, must be your only compass.